Hello everybody and welcome to the sixth video on the interview series. In this video, we're going to take a look at potential 5 questions that would come up on fixed income securities for an interview at a fund accounting firm, either for corporate actions or for fund accounting. I'm assuming that most of the participants who would be getting interview calls would just be about would be about BCom graduates or accounting graduates, and therefore the level of questions over here is relatively elementary. But unfortunately, most commerce and accounting courses do not give a detailed explanation about fixed income securities, and therefore I have already uploaded a couple of videos on fixed income securities as well as the interview series. This is the first interview series on fixed income securities. The top 5 questions that could potentially come up. The first question, a little twist in the tail, identify the odd one out. So rather than asking you definition of what is a commercial paper or what is equity instruments, many times companies want to understand how much you can analyze. So let's look at this type of question wherein you have been asked to identify the odd one out. The 4 options given to us are common stock, preference shares, commercial paper, and American depository receipts. And you've been asked to identify which of this is the odd one out. Let's take a look at each one of them. Common stock is an equity instrument, and therefore it is like the shares, and hence it sounds okay because we haven't compared it yet. The second one is preference shares. Preference shares are also an equity like instrument. The third one is commercial paper, which is a short term money market instrument. And the fourth one is American depository receipts, which are also equity like instruments. So, of the four, common stock, preference shares, and American depository receipts are equity like instruments, and therefore the odd one out is indeed commercial paper because it's a money market instrument. The second question, identify the right statement. Okay, in this question, we're going to ask you whether it is the statement, which of the following statements is indeed right. The first one, GSECs are long term equities issued by the government, treasury bills are long term bonds issued by the government, certificates of deposits are short term bonds issued by the corporates, or is it treasury bonds are long term fixed income securities issued by the government? Let's take a look at each one of them. GSECs are long-term equities issued by the government. That is definitely false because government does not issue equities. Treasury bills are long-term bonds issued by the government. There is a conflict between the two terms bills and bonds. Typically, bills means a short-term instrument which matures in less than 1 year. Long-term bonds are instruments which have maturity, right up to 30 years as well. So the two terms, treasury bills are long-term bonds, are both conflicting in nature, and therefore this statement is wrong. Certificates of deposits are short-term bonds issued by corporates. This sounds like right because certificates of deposits, yes, they're short-term money market instruments. That's true. Oh, but they're not issued by corporates. They're issued by banks and financial institutions. Okay, so this statement is also wrong. And the fourth one is indeed treasury bonds are long term fixed income securities issued by the government. That's indeed right because treasury means it's issued by the government, bonds means it's long term instruments. They are fixed income instruments, they are issued by the government, and therefore the right answer is indeed treasury bonds are long term fixed income securities issued by the government. The next question, identify the odd one out again. Okay, we know that 2022 started off with a bang because we had introduced a whole lot of new reference rates. These included rates like SOFR. Okay, so the options given to us are SOFR, LIBOR, SONIA, or SARON. Okay, so SOFR is the USD interest rate benchmark, secured overnight financing rate. LIBOR is the London Interbank Offer Rate, but LIBOR is no longer used. In fact, the last date for usage of LIBOR was 31st of December 2021, and since January 1, 2022, LIBOR has been completely phased out from all currency and interest rate markets across the world. Is it 3 SONIA Sterling Overnight Index Average? Okay, that's the interest rate for GBP in the London markets, or is it SARON? That's the Swiss interest rates, okay? Secured average rates. So the answer indeed is SOFR, Sonia, and Saron are still in use. The one that's been removed out is LIBOR, and therefore the odd one out is indeed LIBOR. Which of the following has the lowest risk? If you are a risk averse investor and you wanted to invest in bonds of a particular company, which would you choose? Senior unsecured bonds, secured bonds, subordinated unsecured bonds, or equity? Since you're a risk averse investor, if you choose senior unsecured bonds, the bonds may not necessarily have a priority in the claims because it is unsecured. If it is secured, it appears to be much less risky than senior unsecured bonds. If it is subordinated unsecured, not only is it unsecured, it's also subordinated in priority claims. And equities, of course, is the highest risk. So, therefore, if you are a risk averse investor, you would definitely look at investing in secured bonds. What is the formula for accrued interest? Accrued interest calculations often come up as part of fixed income corporate actions processing, and therefore, the simple question, what is the formula for accrued interest? It's a dirty price plus clean price. Is a dirty price minus clean price. Dirty price is the settlement price. Clean price is the traded price. Remember, accrued interest is paid to the uh, seller by the buyer in order to accrue for the period that is intervening between the coupon payment date and the traded date. The dirty price, or is it, see, clean price minus dirty price, or is it clean price plus compounded interest? Okay, dirty price plus clean price, no way, because that would mean the price is exorbitantly high, because that would be the settlement price plus the traded price. Dirty price minus the clean price, that sounds right, because the dirty price includes the accrued interest, whereas clean price does not include the accrued interest. Clean price minus dirty price would give me a negative answer, because clean price is the traded price. Clean price plus compounded interest, no, that's not correct. The right answer is indeed dirty price minus clean price. Thank you so much for watching this video. If you have any questions, do write into me or post in the comments section below. This is Sushila Hariharan wishing you all the very best for your interviews. Thank you.